You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Senior Options Analyst and author of the Options Playbook. All right, so we had a long little scenario with FedEx, and the trades were interesting. It was a very solid educational process. We looked at a diagram. We turned it into a calendar. I probably did okay on that trade. We walked through that scenario last week on what would have happened and how we would have adjusted it. And then we stayed the course. We looked at earnings on FedEx, and FedEx was going to be announcing yesterday. So we decided to do a butterfly because FedEx had made such a big run up over the last few weeks. It basically had gone straight up. We were hoping that the market would just stay kind of neutral going into earnings, and we did a butterfly. Now, normally on a butterfly, you would do it closer to the earnings date, but it was within the week. So we went and we did a butterfly. And so when we entered our trade, I'll go through a quick little summary because FedEx did announce earnings last night and the market did move. The trade turned out profitable if you got out of it fairly soon, if you stuck around all the way into the trading day, which right now we are taping this very close to the end of the trading day. It is on Wednesday the 20th. They announced earnings last night after the close. But the big thing about FedEx is that, and I'm not quite sure, I didn't do the math on this, or do the research, I should say, not the math, but the stock really tanked prior to the earnings. And then it continued a downward slide after that. Now, I can't give the rationale as to why. It's just meant to be a paper trade, so I wasn't following it all the way along. But the stock, the day before the earnings announcement, the actual trading day they announced after the earnings, the stock opened at 261 on that day. And then it ended up closing at down a few points to 258.39. Now, it could just be the news overseas, the Trump tariffs, everything else that happened. But overall, the stock, I would have placed the trade during that day, closer to the close, closer to the 258 level. But we didn't. We did it last week when the stock was fairly close to 260, 250. Trade still did fairly well, though, if you got out pretty close to the open. So here's what happened. The trade that we had on was a long butterfly call at the money. We did a 10-point wide butterfly because that was about the expected move. And all we were looking is that FedEx would not move as much as expected. So we bought, the stock was around 260-250. We bought a 250-250, sold two of the 260-250s, the at the money's, the most at the money strike, and bought one of the 270-250s. We paid $3.40 for it. The market came down after the tariff news on the day they were about to announce earnings. The markets closed. They announced earnings, and it was down on the open. Okay, so it still didn't make the expected move. So our forecast overall was correct. we did not want the market to move more than what the market was expecting. But we don't get what day we tape Options Playbook Radio. It doesn't always necessarily fall hand in hand with the strategy or the timing of the strategy that we're going to put on. So, but with all that said, if I look at the chart and I see what happened, we're just pull up a little 5-minute chart here on the Ally Invest platform, and we see on the open, the market today opened at 257.30, which was a winner, and then within a few minutes, it plummeted down to the lows. Close to the lows of the day. The lows of the day actually happened closer to the end of the market. That's down around 250.109. But the market did come all the way back, and it hit for the high of the day was on the open, and then it ended up at about midday, right around 12:30. It was trading right around 256. Our break-even point on this trade, if you look at the long lowest strike, so 250 plus the premium paid 340. The break even was 255.90. So there were many different opportunities throughout the day that you could have got out at a profitable trade, and I would have got out on the open as soon as the trade hits. I don't like messing around. We were trying to get a volatility crunch. We would have got it on the open. I would have got out of the trade. But if not, if you stuck in it all day long, this trade right now is trading for let me see. I had a quote on it. Let me pull it up. And it looks like it's trading for about $1.50. It's jumping around all over the place because the market's getting ready to close here, but it's $1.50. So if you stuck around all day, the trade was a loser. If you put it on before, the trade was a winner no matter what. And if you did it last week, there were many opportunities throughout the day where that trade could have been profitable. Simple enough. Let's move on to the next trade. So I'm going to do something a little bit different. I haven't really talked about more of the basic strategies, and we're not in the middle of earnings season right now. So there was a major news event that came out in Canada, of all things, about the legalization of marijuana. So in Canada, there's been a push to legalize throughout the entire nation of Canada. They're going to legalize it for recreational and also for medicinal purposes. So as far as Canada is concerned, it's add some volatility into a lot of these drugs that are affected. And there is a stock that was mentioned on CNBC the other day, the Canopy Growth Company, that is based in Canada. And that stock has options that trade on it, and the volatility on these option contracts are fairly high. So right now that stock, as we speak, is trading at $33.74. It's up $1.71. But what has drawn me to this underlying is more so that because of news and everything that's going on just all across the world, as a matter of fact, we see implied volatilities in this underlying fairly high, and on the option contracts. So there's not a ton of options that are available, but let's say you want to invest in the longer term growth of this company. I could get into the trade now that I can do it fairly inexpensively if I was looking to buy a couple hundred shares of it. And as a matter of fact, the strategy that I'm going to talk about today isn't actually outlined as one specific strategy in the options playbook. But I want to talk about buying the underlying stock and selling a covered call, and then also selling a cash secured put on that underlying, saying to myself that I'm going to sell this call and I can get far enough out of the money that if it gets called away, I'm doing great. And I'm also going to say, well, if the news is bad and it comes out and the market tanks on it, I'm willing to buy more. So I'm going to bring in a lot of premium because I'm selling a put below and I'm selling a call above. And this is actually defined as a covered combination. I'm buying the stock, at the same time selling the call, and also selling the put. You can enter this all as one trade, and As always on Options Playbook Radio, we're not looking to make recommendations on any of these underlyings, any of these stocks. We're just trying to look at different scenarios where the option trading might be feasible. I don't know anything about CGC Corp, and I'm not trying to make a forecast on it, but the fact that implied volatility has been jacked up on this underlying because of all the news that's going on makes it an interesting time to do a covered combination. And it's mainly because of the implied volatilities in the options, right? The news is already out there. It's not like they're announcing earnings next week. So we're going to look at the July expiration. It only has monthly expiration. So the July 20th, which is the third Friday of the month in July, is all that we can trade in the near term. And we have obviously July, August, October, and they go all the way out to January. So there's 4 different months that are available. We're going to stay in the short term. We don't know exactly when all the news is going to come through or if anything's going to happen at all. We don't have any idea, but we're just going to say, gee, I like the juice. I like what's in these option contracts. And right now, the at-the-money implied volatility on the most at-the-money, you have 25, 30, and 35 strikes. You got 5-point wide strikes. But the 30 strike call option is trading at about a 65% implied volatility. All right. Okay, so let's set up the trade. This would be one we probably won't follow along on Options Playbook Radio because it's just more so about the concept. We're not trying to do a short-term trade around earnings or a calendar trade going into earnings like we did the last couple of weeks. We're just going to look at a scenario. How would a stock that has some major news, but I might want to play, right? That type of thing. That's what our outlook is for this underlying. It's a very volatile stock. It has a lot going on. As a matter of fact, if we look at the chart on CGC, let's look at since when did this hit? Let's just go overall, and I'll give you a daily chart. And let's look at what's happened since, here's the bottom part, since 410. Since 410, the stock has gone from about $20 a share up to about, right now it's trading at $33.78. So that's the type of movement that this underlying has made around all this news and everything that has happened and everything else that's going on in the world. So obviously, it's hard to jump in at this point in time because it's made a fairly substantial move. So this is one way to do it. And ideally, what I think you would like is, you got to like the stock long term if you're going to sell a cash secured put on it. But if the stock just kind of settles down, we're going to bring in a lot of premium and we're going to lower our cost basis overall on this underlying because we got enough money to buy 200 shares, but we're only going to buy 100 shares to start, and we're going to use the put to buy more if it goes lower, and we're going to use the call to sell it higher if it goes higher. So here's the trade. Right now, the underlying stock is trading at $33.77. So that's going to be our price. The market's moving, but we're going to call it $33.77. We are going to buy 100 shares of CGC, Canopy Growth Corporation. And then at the same time, we are going on the upside, we are going to sell the 35 strike call. And the 35 strike call is trading for $1.75 by $1.85. 10-cent wide spread on a $1.80 option contract. There's a little bit of volume in it, a little bit of open interest. So I'm going to go at the midpoint and say we could fill at 180 on my paper trade. Okay, I'd work that trade, but I don't mind doing this as much when I'm selling options. And in my scenario, I'm going to buy if it goes down and I'm going to just sell the stock via assignment if it goes up. So I'm working on the assignment situation here. Now, on the downside, I'm going to sell the 30 put. I'm going to go a little bit farther downside. So the market, that'd be $3.77. And if I sell the 30 strike put, that market is 85 cents by 90. And so in this instance, we're not going to try to mince it here. We're just going to take it at 85 cents. So we gave ourselves a midpoint fill the call side, we'll say we hit the bid on the put side. So 85 cents plus $1.80. And that means we're going to bring in $2.65 worth of premium on a $3 or $33.77 stock. So right off the bat, we have an 8% downside protection, and we have exactly a 30-day option contract. So this is enticing in that I know that there's some news lingering, but but it's news that is already out there. It's not something that's going to blindside us right now. Who knows what could happen? Any stock could blindside you at any point in time. But we're looking at an 8% worth of premium, selling a covered call on the upside and selling a cash secured put on the downside. Now, overall, you can look at it as I've lowered my cost basis on this underlying to 31.12, right? As opposed to looking at it as I bought it at 33.77, I just look at the whole gaggle of securities. I'm going to buy the stock, I'm going to sell the call, and I'm going to sell the put. And I did that entire thing for $31.12, and that's my cost basis. Ideally, in 30 days, I just really hope it's above 31.12, right? That's ideally what I would like. Now, I don't mind if it goes below 30 if I don't mind owning the underlying. And that's the key here. Your risk is to the downside because you've sold a put, you're a long stock, so you are by far throwing some more risk to the downside. You got 100 shares of stock that would hurt you, and you got a cash secured put that would hurt you. But you're bringing in enough premium that you're hoping that you're comfortable with this underlying. All right. So that's going to be it for this episode of Options Playbook Radio. We will keep an eye on this underlying. We'll see where it's at in a week or two. We got 30 days to see if we buy more or if we sell higher. And if it's somewhere in between, well, that's great. If we still want to buy more, we can. And that's the way that we're going to approach this trade. But the good old covered combination, looking at an underlying stock, this is a trade that I did not put into the options playbook, but I think it's a very common trade. But a lot of people will do it in a couple of steps. In other words, they might buy the stock starts going up. I'm willing to sell it if it goes higher and then sell the put later. They don't always usually do it as one trade. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.